So let's say that you have started a startup and you have made it a unicorn. So first and foremost, congratulations that your company is now valued at $1,000 million. So now I have a question to ask you, and please comment and tell me below that these are your two options. Which one will you pick? So option A, $1,000 million as valuation of your company vis-a-vis having 100 crores in your bank account. So which option will you pick and why? I will reveal my answer along the video, but let me share the story of Paytm Mall. So Paytm Mall at one point in time was valued at $3 billion. Right now, it is valued at roughly $13 million. So its valuation has eroded by 99.5%. 99.5%. So obviously you should ask yourself a question that how are these valuations created? Should you be trusting these valuations? And more importantly, or rather most importantly, should you be investing in stock markets as per the valuation of a company? Super important video. So 3 things that I'm going to help you understand. First and foremost, what exactly is meant by valuation. Second, I will walk you through a very simple process of valuing a company. It's not a sophisticated model. Anyone can use it. Third and finally, we will analyze 5 stocks and figure out whether they are overvalued or undervalued. So let us get the discussion started. And also, many of you keep on asking me that, Akshat, how do you invest in US stocks? Which app do you use? So I use Vested, and this video has been sponsored by Vested. So you can go check the links in the description box. It's a wonderful app. I have had a wonderful experience of using this application, and you can use the link in the description box to avail a special discount. So first and foremost, let us understand what is meant precisely by valuation. So let me give you a very quick commentary on what valuation means in a no-nonsense fashion. So I will be non-diplomatic in my approach and I will call a spade a spade. So the phrase of the today is calling a spade a spade. Let me know what does that mean. In terms of valuations, there are several critical points, but let me discuss the 3 most important ones. First and foremost, valuation is a very, very complex, complicated number. People are trying to get to a very simple answer that what a particular business or a company is worth. Now, companies are of different types. For example, valuing a startup vis-a-vis valuing a mature company or a company that is about to get listed. All these entities can be valued through different methods, variables, systems, and there are hidden agendas at play. For example, many companies, when they are about to get listed, they will say that, you know what, we are the #1 player in India. We are doing this also. We are going to go to the moon also. We are going to beat Tesla also. We are going to make God our brand ambassador also. So therefore, we deserve crazy amount of valuation. And you would have seen this play out last year in the stock market. That many companies in India, many of the recently listed startups, they just came out with crazy valuation numbers. So the first key point that I want to drive home is that valuation is a highly complicated, complex number. No person in the world can give you clarity around whether the valuation of a company is correct or is it incorrect. It's just a guesstimate approximation game. Second key point, that since there is no consensus, there is no single method. For example, many times we use something called as PE ratio method to figure out whether a stock is overvalued or undervalued. Sometimes we use PEG ratio or price to equity growth ratio to do the same. Then the most common form of running valuation is something called as discounted cash flow model. That is one of the most prominent methods for doing valuation. So let me explain DCF or discounted cash flow model, and let me help you understand the complexity as to why there is no consensus even in terms of running methodologies like DCF. So DCF or discounted cash flow in very easy to understand way means this. For example, let's pick an example. Let's pick ITC, and we say that, you know what, in year 0, 1, 2 and 3, it's doing business which is worth, let's say 1 crore here, 2 crore here, 4 crore here, and then 8 crore here, right? So this is the revenue numbers. Let's assume that they are making 50% profits consecutively. So this becomes 0.5 crore, this becomes 1 crore, this becomes 2 crore, this becomes 4 crore, right? So these are your profit numbers. So discounted cash flow in simple terms uses a mathematical formula where what we are trying to do is that we are trying to approximate the current value of these future cash flows. For example, in year 3, that expected cash flow is supposed to be 4 CR. So we are trying to answer the question that what is the value of that 4 crore rupee 3 years from now as of today. So we are discounting this 4 crore rupee by how many years? By 3 years. Similarly, this 2 crore rupee by how many years? 2 years. This 1 crore rupee by 1 year. So the mathematical model of doing this itself is highly complicated. Let me explain this to you through a simple example. So right now, so much money has been printed that the value of money itself has eroded in the last 2 years quite aggressively. But if you were running DCF valuations before 2020, then the rate of money evaporation was not going that fast. So without bogging you down with details, I hope you understand the complexity of running these type of mathematical models and are able to see that how complicated it gets to run even something like a DCF or discounted cash flow model. So now your obvious question here would be that, Akshat, then why is it that investment bankers, VC, PE firms, they keep on building like Excel spreadsheets all day, and they are analysts, associates. They keep on working on these projects all day, night long, and become like Excel ninjas. In fact, you yourself are an Excel ninja and management consulting, and you yourself used to do this work. So yes, because I used to do that work, I can tell you the reality of it. So one of the primary jobs of PE, IB, management consultants are very simple, that justify Excel numbers. So whatever mathematical models, for example, if you have come up with this hyper complicated mathematical model and we say that the value of Paytm Mall is $5 billion. Our job as management consultants or IBs or PE, VC guys is very simple, justify this model. So as long as we can justify it and the management of the company can justify it, that somewhat becomes the valuation of that company. So I hope you realize the fact that number one, valuation is a highly made up number. There is no specific consensus. And even when good investment bankers, ethical investment banker, ethical management consultants, they try to build these Excel models, these can be deeply, deeply flawed. Now you will get super depressed by hearing my honest commentary on this topic, and you would say that, Akshat, then what's the point of even going to the stock market if we can't figure out what is overvalued or undervalued? There is no set method, there is no formula that we can use. Then what is it that we should be doing? So here is a simple framework and method that I will leave you with. So what you should do as a normal retail investor is that you should look at the PE or price to equity of a stock. Now you'll say, Akshat, you had made several videos in the past where you said that P is probably a useless ratio, and you are here changing your tune. No, I'm not changing my tune. Please listen to the videos carefully, understand the context, right? So here I'm trying to teach you to use PE in relative sense, not in absolute sense. Now, what do I mean by that? For example, if you take a look at Nestle's PE, you will figure out that the Nestle's PE is roughly 70. Now, in absolute terms, if you do a little bit of digging, you will figure out that, you know what, TCS's PE is at 32. Now you go check out TCS's PE, it will come out to be roughly 30-35. So you will say that, you know what, Nestle, very, very expensive from a PE point of view. I'm never going to buy Nestle. Okay. So let us assume that you did that. Then what is going to happen? So here is Nestle's PE. Its PE has been trading above 50 right from December 2010. So if you would have seen Nestle's PE back in December of 2010 that it is at 50 and you would have never purchased the stock, then what would have happened? Because Nestle's PE never came down below 50. And what happened to the price? So let's take a look. From 2010 onwards, its price has gone up in the last 10 years from 1500 to approximately 17,000. So that has been more than 11 times gains. So what is the central message? That please don't do an absolute analysis of PE. Something which is trading at a PE of 9 can be a really bad stock, and something which is trading at a PE of 100 can be a very good stock. That is called as absolute PE comparison. PE is useful if you're doing a relative comparison of PE. So what is meant by relative comparison of PE? So relative comparison of PE means that you pick a stock like Nestle or whichever stock you're trying to analyze and compare it to its peers' PE. Second method is that you compare the PE internally. So for example, here the PE has been trading above 50 almost forever. So it is highly unlikely that the PE of Nestle is going to come down quite aggressively. Now, if you do a relative or peer comparison, what you will notice is that if you compare it to something like Britannia is trading at 54 and Nestle is trading at 70. So it's not as if that this is like way off. It is not night and day. So do these two levels of comparisons at least. Now, is this framework comprehensive? The answer is no. This is just one of the aspects of figuring out whether something is overvalued or undervalued. You need to mix market methods to it. Look at the direction of the market, look at the growth of the company, and look at a bunch of different things. But at least through this short discussion, you would have gotten the viewpoint that, okay, of where PE is useful and where PE is not useful. So with this viewpoint in mind, let us start analyzing some of these stocks and let us try to figure out whether these are overvalued or undervalued. This is not an investment advice. You simply need to view this as an education exercise. This is not a recommendation from my side for you to go buy or sell these stocks. Okay. Now, first and foremost, if you take a look at Bata India, it is not a huge company, so to say, right? From a market cap perspective. So small companies, if they are exhibiting higher PE, it is completely fine. Or if the growth rate of a company is very, very high, then also it's fine. So those type of companies deserve a high PE. So first and foremost, let us check the historic PE of Bata India. So you will see that somewhere around 2012, its PE was roughly 61. Then it moved in a range from approximately 35 to all the way around 45 for a very, very long period of time. And then it exhibited next leg of growth. Then it went all the way to 82. And then it has started to come down since then. And right now its PE is 50. So at what PE are you getting the company? So you're getting the company at somewhere this range as of now, if you're doing an internal PE comparison. So now let us take a look at peer PE also. Now this is not the most recent PE number, by the way. This just gives an indication. So if you take a look at Relaxo, its PE is at 105. If you take a look at Campus, 80, etc., etc. So it's not as if that right now, when you're looking at this stock's PE, the current trading price PE, it's not as if then the PE is way off. So from a PE method point of view, is this stock overvalued or undervalued? It looks towards undervalued. Now, if this is supported by the drop in price, then it might become a sensible move to buy. So for example, if you check that at one point in time at its peak, Bata was trading at roughly 2200 rupees. And right now it is trading at roughly 1700, 1800 rupees. So its stock price has fallen by roughly 23, 25%, which is a decent fall. And this stock is coming in our buying range. And this stock is giving something called as margin of safety. So margin of safety simply means that, you know what, stock correction has already happened by 20, 25% for a decent company, which historically has traded at a decent PE, and the PE is coming back to its sensible level. So therefore it becomes somewhat of a sensible buying opportunity. Now you need to aggregate all these things along with fundamental analysis. So you must check the revenues, you must check the profits, you must figure out the growth potential of the firm. If you are then convinced that, okay, you know what, everything is fitting and this company is likely to grow, so at least it will go back up to its previous PE levels. And at that point in time, you are likely to make returns out of it. So therefore, I will somewhat call it as an undervalued stock as of now. What is the second stock that I'm somewhat bullish about when it comes to looking at of undervalued or overvalued nature of the company? So that second company is called as AIRBNB. So first and foremost, if you check the financial statements of AIRBNB, and I'm assuming that all of us know what AIRBNB does, so I'm not spending a lot of time there. So if you check the financial statements of AIRBNB, you will see that the revenues of the company is constantly going up. There was a brief period in 2020 when its revenues went down due to COVID, very, very valid reasons why. And now the revenues are coming back up. Travel industry is growing as of now. Even hotel bookings are hitting all-time high utilization. So this is a growing company, so to say, at least in the short term to mid-term, the business is likely to grow. Now let us do a historic PE comparison. A company like AIRBNB, the problem is that it recently got listed. So it is not a fairly long listed company, so to say. If you check the PE of the company at one point in time, the PE was hitting roughly 128. Now it has come down to 85, 86. Now with a company like AIRBNB, what you need to keep in mind is very simple. First and foremost, it's somewhat of a tech stock. That is the underplay there. That's one. Second, AIRBNB is a monopoly stock. Therefore, it gets higher PE. Very similar to Nestle. That Nestle gets higher PE because it has massive amount of market share in baby food product, etc., etc. And similarly, AIRBNB also captures a large chunk of the travel accommodation market. So therefore, the PE is still very rich. Third and finally, it's a profitable company, which is in an industry which is growing as of now. So from that particular perspective, doing an undervaluation, overvaluation exercise might be really, really tough. So we can only take bets on it. My bet is that it is slightly undervalued. And again, if you look at the price correction of AIRBNB, that margin of safety is very high. So let me show that to you also. So if you check from its peak at 186, it has fallen to roughly 110. So there has been at least 45% destruction of the company, so to say, in terms of stock price. So therefore, that margin of safety. So margin of safety in simple terms means that, okay, its previous peak had already been made. And if the company repeats its performance, then hopefully the stock price will go back to its previous high level at certain point in time. So from that particular perspective, margin of safety is quite high for a stock like AIRBNB. Now comes the third stock, which is called as Angel One. Now here, if you study Angel One stocks PE, it comes out to be roughly 20, right? You will get enticed. You will say that, you know what, okay, PE P is just 20, I will go and buy it. Okay, please study the stock more, because again, as I said, that if you just look at the absolute number, P has no value whatsoever. You need to first and foremost approximate whether the company is growing and is it likely to grow in the future also. So here Angel 1 becomes a great case study. So here you can see that sales have been going up, but what I'm most worried about is that from this period 2018 to 2020, its revenues did not grow, right? It was only after 2021 onwards that its revenue grew quite a lot. I as an investor will get a little bit fishy that, okay, is this like a temporary surge in revenue that has happened or temporary surge in profit that has happened? And is the company likely to sustain this level of dominance? So this is precisely what I will go and research about a company like Angel One. I picked it up as an example so that I can show you that whether or not it makes sense to do an absolute PE comparison or not. So here I'm not giving a verdict whether it is undervalued or overvalued. You let me know in the comment box what do you think about the stock after doing a little bit more due diligence. Now let me talk about two mature tech stocks, one from India and one from the US. And the stock that I want to talk about is Adobe. Now Adobe is one of the biggest tech companies on earth. And if you take a look at its revenue growth, the revenues have been growing despite the company being extremely mature. So this is one good point. Second good point, what should be happening with mature tech companies which are not undergoing a rapid shift in their revenue growth? What needs to happen with those type of companies is that you need to take a look at the buying opportunities on it. A classic case in point is Alibaba. So I had made a video on Alibaba some time back. Unfortunately, after that also Alibaba stock kept on falling a little bit. A lot of people said, Akshat, you're wrong, this, that. See, anyone can be wrong about stock market. I'm not trying to prove that whether I was right or wrong. But if you observe Alibaba in the last 5 days, the stock has jumped by roughly 25%, which is like absolute crazy figure for a mature company. So you need to learn how to value mature company differently. If a company is mature and if it is a monopoly stock and if there is a massive stock fall price and if you feel that there is nothing fundamentally wrong with the company, it might become a great buying opportunity. So I bought Alibaba like anything, right? So I purchased a lot of Alibaba. And now I'm sitting on very good profits on Alibaba. So now if you take a look at the price movement of Adobe, you will see that the stock was trading at roughly 654 and it has fallen by roughly 40% in the last 6 months. Now, if you feel that there is nothing fundamentally off with the company, it can continue to churn out business the way it has always done, then yeah, it might be a great buying opportunity. This is not an investment recommendation from my side, but I'm just telling you to think a little bit about whether this is overvalued or undervalued. Now, in the Indian ecosystem also, there is a company called as TCS, which according to me is getting to sensible valuation levels. In fact, at one point in time, I held TCS, then I sold TCS on a profit, and now I'm trying to get back into the stock, thinking that these are right buying levels or not. So you let me know in the comment box, but let me do very quick commentary on TCS. So let us first and foremost take a look at the historic PE. So you will clearly see that after 2020, there was a PE re-rating that happened for the company, that it went all the way from roughly a 25 to 27 PE all the way to roughly 40 PE, and now it is getting back to approximately 33 PE. So this is what the entire game is. This re-rating of PE had happened for almost all IT companies in India, that they commanded richer valuation just after COVID 2020 and the PE were hitting all-time high, then it consolidated and now these are coming down. I will wait a little bit before I invest because I feel that PE might come back again into that 25-30 range again. So I'm not going to jump on this stock right away. I'm going to wait a little bit, but TCS is a good stock. There is nothing off about it as long as you are getting TCS at a very good buy price. So let me conclude the video by stating a few key points and giving the answer to the question that I had asked at the beginning. So few key points are that number one, please don't consider PE game as an absolute number game. Look at it relatively, look at the past historic performance of the company from a PE perspective. Second, PE is not a foolproof method of buying or selling stocks. It just gives you a basic idea whether something is overvalued or undervalued. You need to invest in good assets, which are growth oriented assets, companies which are likely to grow, etc., etc. Those things are more important. PE just becomes a hygiene factor for you to ensure that if you are not buying something at a horrible price. Now, my answer to my question that would I prefer 100 crores in my bank account Or would I want to build a company that is $1,000 million in valuation? So to be honest, I would prefer 100 crores in the bank account, because when you are having money in your bank account, you get to spend it the way you want. But if you are building a company, then number one, valuation can go really haywire, the way it went for Paytm Mall. And second key thing is that you as a founder do not get control over that money, so to say. It's not as if that you can pick up that money, buy a new Ferrari, etc., etc. So it's not for you to spend per se, it is for you to use to grow your company further. So you have to go and play that growth game. Now, many people would not agree with that, but that is my perspective, and I as an investor can also have my opinion. I hope you enjoyed this video and learned something new. Please press the like button. That will help this video reach out to more people. Thank you so much, and I will see you soon.